Welcome back to Clear Perspectives, highlighting Marietta's fourth quarter 2025 economic and financial market outlook. I'm Mary Allmon, partner and portfolio manager at Marietta Investment Partners. This quarter, growth is slowing globally, with a notable exception of the U.S., and that is impacting inflation, markets, and investment opportunities. The IMF is forecasting growth to slow from about 3.3% to around 3% in 2025 and 2026. That's moderate and stable growth, and it's happening alongside a continued ease in inflation. But here's the twist. The U.S. is actually experiencing an acceleration in growth, powered by strong private demand and major investments in data centers and AI infrastructure, although while inflation here remains elevated. The result is that some households, companies, and markets, they are thriving, while others are continuing to fall behind. This is what economists refer to as a K-shaped economy. In the U.S., economic momentum, it remains impressive. AI-driven capital spending, consumer demand, they're fueling growth even faster than we expected, but inflation is still a problem. Prices aren't surging like they did in 2022, but they're still above the Fed's target and rising, albeit modestly. We expect inflation to stay elevated into 2026 as tariffs and supply constraints, they continue to ripple through the system. A really good example that I like to highlight of the complicated mix of strong demand and inflation, it's the housing market. Demand is strong, but builders are facing rising costs and labor shortages, keeping supply tight. In that world, that dynamic benefits existing homeowners who are locked into low interest rates, while renters and new buyers, they face affordability challenges. The labor market is also telling us a slightly more cautious story. Unemployment, it remains low, but hiring plans have slowed to levels that we haven't seen since 2009. That's prompted the Fed to begin cutting interest rates, choosing to support full employment even at the risk of higher inflation. So let's take a step back and just think about how this all works out in the markets. Stock market leadership, as it continues to remain very narrow. Companies that can leverage scale, capital efficiency, and pricing power, that's who we are seeing as the winner. I continue to favor areas with demonstrable earnings and secular growth themes. For example, technology, AI and cloud infrastructure, productivity tools, so supported by real earnings, capital spending, and operating leverage. Companies that are focused on energy and grid investments. We think rising computing demand, that's going to fuel a new cycle in power generation. Also, we like mega cap companies, those with pricing power, scale, balance sheet strength. I think they'll perform slightly better in a higher inflation world. Corporate profits remain one of the central drivers of stock market returns, and we forecast them to grow by double digits through 2026. The combination of the Fed easing, strong economic growth, and really outstanding corporate profits, that puts the market on very solid fundamentals. The current market valuations, they're high. They reflect this positive landscape, but high valuations on their own, I don't think that will fundamentally change the positive narrative. Outside of the U.S., the pattern I continue to see is slow but steady growth with easing inflation. Europe is stabilizing as inflation cools with policy support and selective fiscal measures. China, it's kind of interesting to me. It's reemerging as a serious AI and manufacturing player, leveraging low costs in energy and access to critical raw materials. Really, across international markets, we see the best opportunities where three conditions align: reasonable valuations, credible policy frameworks, and strong links to technology and manufacturing ecosystems. I think emerging markets remain a selective play, especially countries with resource strength and currency stability. And finally, let's take a word on fixed income. As the Fed cuts rates, that means money market yields will decline, and that reduces the appeal of short-term cash and short-term alternatives. Bond yields for short-term, those will fall, while long-term rates, those will likely remain elevated just due to the higher U.S. debt levels. In this environment, I suggest high-quality short to intermediate-term bonds and investment-grade credit over high yield. To sum it all up, the global economy is balancing between soft landing and divergence. The U.S. is growing faster than the global economy with higher inflation and concentrated but strong market leadership. Outside of the U.S., steady growth and lower valuations have offered very selective opportunities. For investors, this is a time to stay disciplined, focused on earnings leadership, and position portfolios for both growth and resilience. As always, I thank you for watching. I really invite you to connect with Marietta and share your views on our outlook.